For more on this, I spoke to Peter Conti-Brown. He's a professor at the Wharton School of Business in Philadelphia, and I asked him how likely is it that they will raise rates?
That's the $64 trillion question at this point, really, is timing that question. I'm frankly agnostic on that question, on the specifics of will it happen now, will it happen in the next FOMC meeting. The bigger question is why does this 25 basis point change matter so much? And it matters so much because an entire generation of Wall Street traders and indeed other market participants has never known anything else. There's a difference between a 0% interest rate, which the Fed is simply saying money will be free for the taking from banks, and interest rates will be so low to encourage all kinds of borrowing, versus one that says, well, you're not quite sure where interest rates are going to be. Once we cross that psychological threshold, we'll be back in the place where central bankers want to be, which is keep the public guessing as to exactly what the interest rates are going to be for any given point in time.
Let's get to the impact. You say that these traders don't remember a time when it wasn't at zero, but I can tell you there's a lot of people who do remember that mortgage rates were at 12, 13, 14%. And they think, getting a mortgage right now at 3 or 4% is pretty darn good. And even if they raise it a quarter point, sure, so what? Are these people right?
Well, they're right in the sense that, if especially if they're locking in a fixed rate mortgage at this difference, what's the difference that you end up paying if you're talking about 3.5 versus 3.75? It's not nothing over 30 years, but it's not that significant. And more is the question of what is going to come in the future. 0.25% is just the liftoff. The Fed and other central banks are hoping to be airborne, meaning returning to a normalized conventional monetary policy where interest rates are much higher. Is there a big difference between 3.5% and 5.5%? Well, you bet there is. And I think that's the thing that some market participants are fearing, some are welcoming, but everyone is talking about. It's not so much the 25 basis points initially, it's where is the Fed going over the long term.
So in the banking world, we have a term called the carry trade, essentially borrowing from one place to invest in another. When rates are at zero, we can borrow from the Fed, we can borrow from the banks, we can borrow from each other because rates are very, very low, and you basically have either cheap or free money. We take that money and we invest it elsewhere in other people's stock markets, other people's real estate, and we bet on the fact that as long as you make more than 0%, you somehow would come out ahead in theory. So the concern from the World Bank is they're saying that if the U.S. raised rates, that would negatively impact other countries. And I want to hear from you, is that a legitimate concern, number one? And two, is that something the Fed, for them, it's a priority what happens to other countries?
So it's a completely legitimate concern for exactly the reason that you mentioned. I mean, the Fed is operating in an entirely but unevenly integrated global financial and economic system. So the carry trade that you're talking about applies not only to capital flows, where you're trying to take your money into borrowing it somewhere and trying to invest it at a higher interest rate somewhere else, but also affects the flow of goods and services and indeed even people. So it's entirely a global game that the Fed is playing. It's more of a global game today than they've ever played it before. But in fact, the Fed has been in a global system since its founding in 1913. So it's a completely legitimate concern for the World Bank and indeed anyone else inside or outside of the Fed to be thinking about the implications. And so the question, is the Fed thinking about these? And there's just no question there. Yes, they are. Again, they have always been thinking about international consequences of domestic monetary policy considerations. The real question is it a priority? Would the Fed say, you know what, there's going to be negative repercussions of liftoff for the Brazilian economy. The Brazilian economy is already pretty weak, so maybe we should hold off. That's the kind of thing that you're not going to see. The main concern that the Fed is going to have in making this decision is trying to understand the economic reality of the U.S. economy and managing their dual, some would say triple mandates for price stability, maximum employment, and again, that third mandate would be financial stability. So long as they're keeping the financial system stable, then they want to make sure that they are at a place where inflationary concerns aren't overtaking the question of maximum employment.